Welcome to Opales Television. I am in Zurich together with Christoph Manser. Christoph Manser, he is the head of the Hedge Fund group within AXA Investment Managers. Tell me a bit more about your group, how much assets you run, and what's the overall significance, what's the overall role of your fund group within AXA Investment Managers?
AXA Investment Managers is a subsidiary of the AXA Group, and on behalf of AXA as well as third-party investors, we're managing approximately $650 billion US. Within the AXA Fund of Hedge Fund business, we're managing about $5 billion, both on behalf of AXA clients as well as third-party clients, all of which are institutional clients. We have a team of 35 people who are mainly based in London. And we are, as I said, we're focusing on institutional clients, and let me give you some details about what we see in the marketplace. Let me first tell you that I think that the secular trend that we've seen emerging sort of mid-2000s, or let's say 5 to 7 years ago, I think is still unbroken. That secular trend towards higher allocations from institutional investors to hedge funds or funds of hedge funds. The reason is quite simple. I think it is clear that institutional investors still have to earn returns on their assets. And given the limited opportunity set, it is important for investors that they can improve their risk-return trade-off in their portfolios using hedge funds or fund of hedge funds for the same matter. And they have realized that they can achieve that improvement of the risk-return profile of their portfolios using hedge funds or funds of hedge funds. What they basically need is also quite simple. What they want to achieve and with their hedge fund allocation is a stable return stream, or in other words, they want to have high risk-adjusted returns with a relatively low correlation to the equity markets in particular. However, I think compared to the last 3 to 4 years, besides just focusing on the returns, I think the focus in general on topics like risk management or process is much higher than historically. I think there is a key reason why things have changed, and if we're scrutinizing, or if we're trying to learn from history, then I think we have to admit that as an industry, the hedge funds have not quite delivered on that stability of returns. And hence, today, investors are much more scrutinizing topics like process, maybe also structure, but certainly also risk management.
Chris, you mentioned the stability of returns that are really important for an institutional investor. Tell me more, what are your criteria there? So when do you say, well, this hedge fund really has stable returns? And also compared and linked to that, what type of volatility can you accept and not accept?
That's a great question. But I think first and foremost, we have to take a step back and remind ourselves that the best way to invest into the hedge fund asset class is by building a multi-manager product or a fund of hedge fund, basically. The concept is based on diversification. So rather than looking at the risk-return profile of the individual hedge funds that you're investing, on the fund-to-fund level, you have to make sure that you're running a well-balanced portfolio. So it's not about avoiding volatile managers. It's about building portfolios where these volatile managers are correctly sized and they're being paired or commingled with managers who have different return drivers and different risk drivers. And by way of doing that, you're achieving level of diversification, and that allows you to target a specific risk return level. And I think to answer your question more concretely, on the fund of hedge fund level, the industry has been selling low volatility products which are somewhere around 4 to 5%. And I think that makes a lot of sense. I think it's a nice volatility level which is similar to that of a bond portfolio. So it allows you to shift risk as an asset allocator out of fixed income into funds of hedge funds. To go into a little bit more details, as I said, you have to try and create balanced portfolios. So with that, it is clear that asset allocation on the fund of hedge fund level is important. And the ultimate goal is to make sure that the level of risk that you're taking from that perspective is both contained and also understood. For example, it's not about avoiding beta in the portfolio. I think it is about understanding the beta component that you have in your portfolio and ideally make sure that it is controlled either by your asset allocation and or also by your manager selection. And so with that, the bottom-up component comes into play as well. And from a bottoms-up perspective, what we feel is very important is to fully understand the risk management approach that the manager has. Again, if you want to control your beta on the portfolio level, you have to understand how the managers themselves are contributing to that beta and how themselves they are controlling the beta. There are different ways that a manager can do that. They can have certain net exposure limits, for example. They can also be very opportunistic in terms of running net long or net short betas to the equity markets, for example. Or they can have other risk reduction techniques which, as an investor, make you feel confident that they will be taking action if any directionality is working against them.
Now, Chris, you as a hedge fund or fund manager, what are your criteria to have somebody in your fund? What are you looking for?
I think first and foremost, we want to fully understand how the manager is making money, where the manager is creating alpha, and why this alpha is sustainable. And then secondly, we want to make sure that the risk management that the manager is employing is adequate for this strategy. If you combine that, then those two elements, I mean, in a nutshell, I think we want to see an asymmetry. We want returns, we want a manager to be able to capture upside returns while managing the downside risk. And this asymmetry is really what we believe is attractive. And to make a simple example, if a manager is providing similar returns, upside or downside, the downside obviously being negative, this would mean that the manager is just exhibiting beta and would not catch our attention. So it's about the uniqueness that the manager brings to the table and its ability to produce asymmetric returns.
Do you look for certain sizes? What's your minimum? What's your maximum? Do you say big funds are too big, or do you say small funds are too small?
We would like to be flexible. It is fair to say, though, that in early 2007 we have internally decided to shy away from a lot of the larger names. Back then, as you remember, a lot of the big names have been attracting a lot of capital, maybe the lion's share of the capital. And in contrast to that, we have taken the decision to look at smaller managers and in some cases clearly shy away from the larger ones. Having said that, we have exposure to larger managers. Some of them have been large when we've invested. Some of them have gotten larger over time after we've invested. I think the key is to be flexible, to be able to invest on day one, and also to be able to access some of the more established managers where access is more difficult to achieve. The reason why I think it's important is because ultimately we're looking for the best managers, because it's the best managers that will provide the characteristics that I've been alluding to before. And if you are inflexible, if you're limiting yourself to either big or small, it is very likely that as a result of that, you will be ending up with a portfolio of less quality managers.
Okay, so you've covered fairly extensively your situation and how you manage the larger funds. How do you work with smaller funds?